Hey everyone, thank you for tuning in to another video. In a future episode, we're going to go over how to buy a house, but before we do that, we need to talk about what a mortgage is. A mortgage is a special type of loan that is used to buy a house or a property. Normally, mortgages are very large, in the hundreds of thousands of dollars, and they are paid off over many years. The average mortgage is between about 25 and 40 years long. People get mortgages from banks or companies that specialize in lending them. How it works is you apply for the loan, and if you get approved, then you get the money, but you're going to be charged interest on the money. Interest is a fee on top of the loan that you need to pay back. That's how the lender makes money. If you borrowed $100 and you have to pay back $105, the $5 is interest on the loan. I should also mention that it's not just people that get mortgages. When a company needs to buy an office building, it gets a mortgage. When a business owner wants to buy a restaurant space or a barber shop, they need to get a mortgage. Even a university that buys a building from our lecture halls, they need to get a mortgage too. The point is, if you want to buy a property, you need a mortgage. So now that we know what a mortgage is and what they're for, let's talk about how to get one. Say you saved up money and are looking to buy a house now. Well, what you'd want to do next is go for a pre-approval. A pre-approval is an assessment the bank or lender does to see how much mortgage they are comfortable lending you. They'll look at your income, they'll look at debts that you have, they'll look at how much money you saved, your credit score, basically your entire financial position, and say, hey, based on this, we're okay lending you X amount of dollars at this interest rate. The better your financial position, the more lending you'll be able to get. And if you've shown that, look, I always pay my bills on time, I always pay them in full, you'll get a better interest rate versus someone who doesn't. During the pre-approval, you're going to have to prove your identity, you're going to have to prove that you do have these savings, and you're going to have to give any info about debts you may have, so student loans or car loans, etc. It may sound intense, but keep in mind, this lender is potentially giving you hundreds of thousands of dollars, so they want to be sure that they can get it back. So let's do what we always do here. Let's give an example. John saved $65,000 and he's looking to buy a house now. After doing this pre-approval with TD Bank, he was approved for $400,000 of mortgage at 3% interest. So that means with the money he saved and the mortgage he has, the most expensive house John can afford is $465,000. Okay, I know that was a lot of information, so let's just sum up where we are so far. If you want to buy a house, you need to get a mortgage. When you're ready to get one, you get pre-approved, and based on your financial position, you'll get the max you can borrow with the interest rate you're going to be charged. It's also good to note you can go to multiple lenders and lots of banks and compare their pre-approval so you can pick the best one for you. Speaking of interest rates, we should also talk about those because they're kind of tricky. So you can get two kinds of rates. The first one is a fixed rate and the second one is a variable rate. Fixed rates are exactly as they sound. For the term of your loan, you get the same rate. That means every month you're going to pay the same amount. Variable rates change based on what the prime rate is. The prime rate is the Bank of Canada's interest rate, and this is what the government charges the banks for interest. I know it sounds confusing, but it's pretty straightforward. So let's say that a lender is offering you 3% fixed rate and the variable rate is prime plus a half. If the prime rate is 2.5%, then your variable interest rate is 3 because it's the prime rate, which is 2.5 plus a half. 2.5 plus a half is 3. Now let's say in 4 months, the prime rate drops to 1.5%. Then your new interest rate becomes 2 because it's prime, which is 1.5 plus a half, that gets you 2. Variable rates can be risky because depending on how the prime rate moves, you end up paying less or you could end up paying more than a fixed rate. So it really depends on what your risk tolerance is and how you think the economy is going to go in the next couple of years. It is usually recommended for first-time home buyers and people that like cost certainty to know how much they're going to pay each month for X amount of years to go with a fixed rate. But there are potential cost savings if you're able to weather the storms and you're comfortable with the variable rate. Now, one other thing we should do at this point in the video is clear up some common terms you're going to hear when you're looking up a mortgage. One common thing you will hear is when someone describes their mortgage, they might say, oh, my mortgage is a 25-year, 5-year fixed, or maybe it's a 30-year, 3-year variable, for example. All that means is they're describing how long the mortgage is for and how long they have their current rate for. So for example, if a mortgage is 25-year, 5-year fixed, what that means is they have 25 years to pay back their total mortgage. So in John's case, he has 25 years to pay back the $400,000. And he has that 3% interest rate for 5 years. Since a mortgage is so long, it is impossible to predict what the interest rate is going to be 5, 10, 30 years from now. Lenders offer you an interest rate that only apply for a certain period of time. So maybe for 5 years, you'll have an interest rate of 3%. All your payments are going to be calculated with 3%. Then after your 5 years ends, you have 20 years left on your mortgage. Your 3% interest rate is finished. Once that's done, you're basically going back to step one, where now you're going back to other lenders and saying, hey, look, I have 20 years left on my mortgage. I'm looking to lock into another rate. What can you offer me? Maybe the rates have gone down. So you want to lock in at 2.5% for 3, 4, 5 years. Then your payments will be calculated on 2.5%. But maybe the rates have gone up. It's really hard to say where the economy is going to go. So you have to be strategic about where you're locking in and for how long, because you may end up paying more in the long run if you're not careful. So at this point in the video, we've talked about what a mortgage is, how to get one, and some of the terminology and how the interest rates work. But the last piece of this puzzle that we're going to talk about is how the payments are actually calculated. So there is a formula people use. By putting in all these variables and doing the math, you can calculate your payment. But nowadays, most of us just use the online calculator because it's much easier. All you have to do is put in your inputs. So how much is your mortgage? How much is the down payment you're putting down? What's your interest rate? So in our early example with John, our purchase price was $465,000. Of that amount, we're putting $65,000 down ourselves, and we have a 5-year fixed interest rate, and let's say the interest rate is 2.5%. This calculates to about $1,800 a month that we have to pay. Assuming that you kept the same interest rate for 25 years, you would end up paying $537,000. Keep in mind the house was only $465,000, so that excess of $70,000 is interest that you paid over that 25 years. This is why lenders are willing to give out mortgages, because they can make so much money over time. The only thing they're concerned about is, will you pay? As you look through and tally up all the costs, you'll probably notice a line item called mortgage default insurance. If your down payment is under 20% of the house cost, you'll have to get mortgage insurance. What that does is it protects the lender so that if for whatever reason you cannot repay your mortgage, they will be able to recoup their money. Basically what it is another charge to you because you didn't put 20% down on the house. It is an added charge to your loan, so from borrowing $400,000, it now becomes $412,000. So John put down $65,000, which is only 14% of the house. If he put down $20,000, that would be $93,000. He would not have to pay any mortgage insurance. So in that scenario, the house is $465,000. He puts down $93,000. His mortgage is only $372,000, and there's no mortgage insurance on that. So his monthly payment becomes almost $1,700. In 25 years, he would have paid $499,800, which is only $37,000 of interest over the life of the mortgage. Compare that to when he puts down 14% and he pays $70,000. As you can see, if you can manage a 20% down, your monthly payments will be much lower and you will pay less interest over your loan. Of course, it's understandable that it can be hard to save $93,000, which is why the mortgage insurance exists. It's usually recommended to put down as close to 20 as possible, and if you have too little of a down payment, say 5% or less, you'll probably be rejected for a mortgage. If you are unable to pay your mortgage for 1 or 2 months, you'll be charged a late fee. But if you continuously are unable to pay, then the bank will get possession of your home and sell it so they can recoup their money. So it is really important that you lock into payments and into a loan that you can afford if things ever go south. I know that was a lot of content to digest, but I just wanted to touch on all the important concepts of a mortgage. In a later episode, we're going to talk about what it's like buying a home, but I think having the basics of a mortgage covered is a great step. If you have recently got pre-approved or are thinking about it, I'd love to hear your thoughts and experiences in the comments. And as always, remember to like, share, and subscribe. Thank you for listening and have a nice day.